Since 2000, private equity firms have collected over $1.3 trillion in fees and dividends, while the companies they own shed more than 1.3 million jobs. This video explains exactly how they do it and why nobody stops them. $11 million per year per company, paid to the firm regardless of performance. Those fees reduce the company's cash available for operations, payroll, and investment. And in most fund agreements, those fees are guaranteed even if the company goes under. Before a sale or IPO, PE firms often execute a dividend recapitalization. They force the portfolio company to borrow additional debt and immediately pay that borrowed cash to the PE firm as a dividend. In 2021 alone, dividend recaps hit a record $61 billion across U.S. private equity deals. The firm recovers its original equity investment before the company is even sold, meaning it faces zero downside risk on the remaining bet. If the company later collapses under the new debt, the firm has already made its money. In 2014, Golden Gate Capital sold Red Lobster to Darden Restaurants, but first engineered a sale-leaseback, selling Red Lobster's 500 owned restaurant properties to a REIT for $1.5 billion and pocketing the proceeds. Red Lobster was now a tenant in buildings it used to own, paying $170 million per year in rent it had never owed before. By 2024, Red Lobster filed for Chapter 11 bankruptcy, closing over 100 locations and laying off thousands of workers. The real estate was gone, the cash was gone, and the brand was left holding the bill. A landmark 2019 study by economists at the University of Chicago and Harvard tracked 9,000 PE buyouts over 25 years and found that employment at PE-acquired firms fell by an average 13% within 2 years of acquisition, compared to a 1% decline at comparable non-PE firms. The cuts follow a recognizable pattern: corporate overhead first, then mid-level management. Standard PE holding period is 3 to 7 years, engineered specifically to collect fees, execute operational changes, and exit before long-term consequences materialize on the balance sheet. By the time a company shows structural stress from its debt load, the original PE fund has typically already distributed returns to its limited partners and moved on to next raise. The firm then launches a successor fund using its stated track record, which includes the early profitable exits but excludes or minimizes the late defaults. Investors who lost money in Fund 3 are